Hi, this is Mani from bse2nse.com. So in this video, we're going to talk about a particular options trading strategy, which is popularly known as Strangle or Hedge. So I made some key points here that you need to follow, and I'll also explain with the help of a chart. So before we proceed to this video, if you are a trader, you can subscribe to our YouTube channel for more such videos. And I'm also an authorized person for Zerodha. And I've made private videos on YouTube on trading strategies and more details on how specifically to trade. So getting back to this particular strategy in options, basically if you're very new to options trading, then I would suggest you to watch my other video where I've covered about the basics of options. I'll put a link of that video in here, right here, and you can watch that video first. So basically the basics of options involve what is options premium, what is an expiry, what is a spot price, what is a strike price. And since you're always trading on the options premium, it's very important that you know how does the options premium change, meaning most of the options contract will become zero towards the expiry. So you should understand the risks involved. You should understand how the premium price changes. So that is very critical before you start off with trading in options, right? So all those are covered in the video of my basics of options trading. So I'll put a link here. You can click and watch that first. And if you understand all that, then basically an option strangle, it's called a strangle because strangle means that you're like holding and pressurizing from all sides. And a hedge also means that you're betting both on the upside, also on the downside. Basically, you're betting in all the directions possible. So in an options strangle or a hedge strategy, you will buy a call option. You'll also buy a put option. Normally traders would want to bet one way, meaning they take tips from somebody or they try to predict which way markets are going to go, and they buy only a call option or a put option. They don't buy both. But in this strangle or a hedge strategy, you will buy both in equal quantities, or you will invest amounts equally, meaning you will pick a call option contract which is trading at probably 100 rupees, and you will also pick a put option contract which is trading at 100 rupees. You will buy let's say 5 lots on call option, you will buy 5 lots on put option. So thereby you will place your bets on both upsides and downsides equally, and then you will wait for the markets, in our case Nifty or Bank Nifty, to move substantially by at least like 5%. And the one thing that you need to know is try to avoid a hedge strategy or strangle strategy having positions in the last 10 days of expiry, meaning if the expiry is on 26th or 28th, you should not have positions. It is risky to have positions after the 16th or 18th, because towards the expiry the premiums will tend to fall heavily unless the markets are going to move in your favor. So basically the strategy is assuming you're investing 100 rupees in call option and 100 in put option. Now either if the call option doubles or the put option doubles, then you will obviously be in a profitable situation, meaning your net investment is 100 in call option and 100 in put option. So you will once the call option doubles, assuming the call option doubles and becomes 200, the put option may become something like 30 rupees or 40 rupees. So both put together you will have an opportunity to exit at 240, but your investment is only 100 plus 100 200. So basically a simple strategy is to invest equally and have a stop loss once either the call option or the put option has doubled. So that way you are safeguarding your capital, and you're safeguarding and you're making sure you'll be in profits for sure. Or if either the call option or put option has become in the money, because when you are entering, you will enter the outside the money contracts, basically because the outside the money contracts will rise a lot once the markets cross the spot price. So basically you will enter when the enter contracts which are like 100 points or 200 points away from the spot price. In case of Bank Nifty, you can probably even enter like 300 400 points away from the spot price. So the only case that when you follow this strategy, out of 12 months you will make like very good returns in like 6 months. Probably 2 to 3 months you will probably not be able to make much profits or losses. In 2 to 3 months, when the markets are like extremely flat and not moving, then the premiums will reduce on both the sides. So so normally out of 12 months you'll be able to gain like 6 months. 2 to 3 months will be like you'll have to exit with no loss or no gains, and 2 to 3 months you may end up in losses, and most likely you will end up in losses because 2 to 3 months probably the markets will not move much. And there is a way to identify all this, meaning when markets will take a one directional movement and when it will not take a one directional movement. So that input I'm not giving in this video, and you will get tips and you will get more insights on when to enter into a hedge strategy. And those are private videos that I share with only Zerodha clients of bse2nse.com. You can log on to bse2nse.com and you can join us if you think that it'll help. So I'll move on to showing and explaining in the chart. This is the Bank Nifty chart, and this is a 3-month chart, and each candlestick represents one day. And at the bottom you can see the dates: 6th Jan, 24th Jan, 15th, 13th Feb, 5th March. And on the right side you can see the values: 9,500, 10,000, 10,500, 11,000, 11,500. So let me explain what hedge strategy means. This is like 5th March. So at the start of the month, what I'll do is I'll enter into, let's say here markets are around 10,600 or 10,700. So at the start of the month, I'll buy 10,500 put option here, somewhere here, and this is 5th March here. Let me mark that in black. This is 5th March, you can see. So at the start of the month, the first week, I'll probably enter into here when the markets are around 10,600 to 10,700. I'll buy 10,500 put. So I'll mark that here, 10,500 put. I'm marking that in red because it's a put option, and I'll buy 11,000 call option. Assuming both may be at a premium of let's say 150 rupees in this case, and the lot size is 25. The premium may be at like, let's say 150. I need to downsize this, right? And the call option and the put option premium could be like at 150 rupees, correct? So in this month, if you see, I'm also going to like draw a circle around here. Let's draw a circle, right? So this is a simple hedge strategy, right? So you buy a put option, you buy a call option, and assuming you've been holding for the last 2 weeks, this after this contract, like 11,000 contract, here now it will be like worth almost like 1,000 rupees because it has crossed the it will actually be worth even more, like it could be worth now like 1,100, I would say, correct? Let's downsize this. Okay, I want to move this thing out because this is blocking the 12,500 mark actually. Yeah, so I'm gonna draw this here. correct. So typically what happens is I invested here 300 rupees in the hedge, 150 rupees and 150 rupees. Now this 150 rupees may trade actually at only something like 20 rupees, maybe possibly. This would have gone down. I'm going to mark this in red. So this would have become only like 20 rupees now. But the point is, you invested 300 rupees. Now that has turned out to be like 1000 rupees. So 1100 here and 1120 here. So potentially the 300 rupees that is invested, the lot size is 25. So you would need like to buy one lot on each side, you would need like 300 into 25 is 7500. If you had invested 7500 in this hedge, now it would be worth 1120. So that's almost like 25,000. So again, in this case, this month we had a huge rally. Bank Nifty bounced back, and it had corrected a lot before, and it bounced back a lot. So basically, the hedge strategy becomes very powerful when the market is breaking out or is taking a one directional movement. But in this zone, if you see, I can mark like this is typically not. This zone was a zone where you could have actually like you would not have made much profits, and in fact you may have made losses also. But then this particular zone here, where again it starts to move, it takes a particular trend. Even this zone would have been extremely good to enter into a hedge. For example, like right here, if you had entered into a hedge here, in this case you would have actually made huge amounts of profits on the put options. So basically you are not betting one directional in a hedge. You will buy both the put option, call option and the put option. So when the market is breaking out of the contracts that you are choosing, and when either the call option or the put option goes up a lot, that's when you gain overall. So like in this case, 300 invested became more than 1000 rupees. So basically you just need to know when to identify one directional movement in the market. It can be based on candlestick analysis, it can be based on Bollinger Band. So like I said, if you want to know more about how to predict one directional movement, which is very ideal for a hedge strategy in options, you can join us in Zerodha. You're also welcome to try and guess how to predict one directional movement, and you can comment on this video. And if you are definitely right, I'll comment back that you are very close or you're very good in identifying a one directional movement. And this is a popular strategy and very good strategy for beginners who probably do not know how to trade, because this is very effective in terms of there are a lot of events like Federal Reserve events, the RBI meeting, the dates when inflation is announced, the date when IIP is announced. Those days it's hard to predict which way the markets will go. So having or following a strangle or a hedge strategy will be really helpful. So like I said again, join us in Zerodha if you want to learn more. And if you like our videos, subscribe to our YouTube channel. Feel free to comment in this video or log on to bse2nse.com, and you can post any queries or questions and I'll get back to you. Thank you. Bye bye.